As now, Ravi, this has been a disappointing set of numbers. Margins have come off, as well your same-store sales. That came as a big shock. Is this trend looking like changing in October at least?
See, we will not be able to give a color for the October, but when you look at the consumer sentiment, for last couple of quarters, we have not seen any change in the consumer sentiment. And I'm saying change in the consumer sentiment, I mean the positive uptick in the consumer sentiment. And the discussion which was going on a while back also is pointing out to the same, saying the kind of the recovery which everybody was expected in the market, that has got protracted. And as a result, the consumer sentiment also is not improving. And as a result, you can say our growth is 3.2%, which is there. But when you look all around also, you look at the opposition, what kind of same-store growth they have, almost all of them are in negative territory. And I agree, on the back of it, we have a positive same-store growth, that is appreciable. But I think the core concern which you have and quite a lot of investors have is the margin dilution which is there in this quarter specifically. And when you look at the margin dilution, there are various cost line items, and one specific cost line item which has created the dilution in the margin is the personal cost. The personal cost has increased about 240 basis points versus Q2 last year to Q2 this year, and there are reasons for it. And first and foremost, the reason is that the inflation in the payroll is higher than the inflation which we have taken, or the price increase we have taken in the product prices, and this will be continued pattern even in the going forward, and this has been the pattern in the past as well. Second factor is last year Q2 we had a negative same-store growth -5.3, and this year we are positive. So level of incentive earning for the employees were almost negligible last quarter in the previous year, but this year people have earned incentive, so we have to make provision for those expenses. But third factor is that we have opened 3 new commissaries, Guwahati, Nagpur, Hyderabad. There is a manpower cost gone up for that also. Now if you just look out, leave out the personal cost, we have moderation in the raw material prices, which is a big positive. All other costs are rising in tandem with the growth in the business. Now going forward, what we expect is that there will be recovery, but the recovery may be protracted, as the predecessor also said, that growth may be protracted, and maybe some recovery will be seen in FY17 now. That's what I like to say about it.
Okay. So, Mr. Gupta, you said that the consumer demand is weak. Is it that people are consuming lesser pizzas, or is it that people are moving away from your brand to other brands in the market?
It is an interesting one, and let me say that in last 3-4 years, while the consumer sentiment has been weaker, there's all sort of brands which have entered. All the international brands practically have entered India, be it a Starbucks, Wendy's, Burger King, or Dunkin' Donut. So you name the brand, practically they've entered the Indian market. There's another phenomenon also we have seen is the food aggregator have entered in the market, whether Food Panda, Tiny All, Swiggy's, and Zomato, and Just Dial also just entered. Now all of this is a positive and negative. When you look at short-term basis, typically it is said that they will take the existing market away, because all these brands will take away the existing consumer. But a longer term basis, they are very good for the market, because what happens is, if there's more variety available to the consumers will come forward and eat out of home food more often. And second is, the competition by way of food aggregator also gives more value to the consumers. Yep. As a result, the overall market expands faster. But let me share one fact with you. Food aggregators are in the space of delivery, and we are the leaders in the delivery. Typically, it will be perceived that we'll be losing the delivery business to this food aggregator. Yep. But the fact is, our delivery business is growing faster than the takeaway and dining business at this point of time.
Okay. Well, in any case, if you can tell us when the pressure on margins might recede, because you are going to open new outlets, give us an idea of how many outlets in the second half, and therefore likely how much more pressure on your margins.
Okay, let me first address the question on the margin first. We have delayed actually our increase in the prices. We typically take increase in prices in the Q1. June typically we take the price increase. This time we are doing some pricing trial around the same time, and as a result, our price increase impact got delayed to September. We will have full impact of the price increase, which will be visible in the Q3. As a result, whatever the dilution impact of EBITDA has been in the Q2 will get fully neutralized, or I can say almost neutralized in the Q3. Now, second part of the question is how many restaurants we are going to open. We are staying with the same outlook which we have given earlier, that we will open 150 new restaurants for the Domino's Pizza and about 30 new restaurants for Dunkin' Donuts. We are fairly upbeat for the long-term growth story of the India. It is only we are not sure as to what is the exact timing when this segment recovery will happen.
Fair point. That's exactly what we were discussing with Prabodh Agarwal as well. Thank you very much, Ravi Gupta, for joining us with your update on the Q2 results. Prabodh, to come back to you, you heard